Hello investors, how are you doing today? Do you think you need an economic degree to be a profitable investor? Do you really need to have gone to university or college to get an economic degree for you to make the right decisions when you're trying to make money in the market? Maybe you do. But what I know for sure is that you're going to need the basics of economics. You need to understand the economy in the most basic level if you want to be a profitable investor. And one of the ways to be able to grasp the basics of these economic trends and the waves that we go through on a daily basis is to understand the leading economic indicators. Economic indicators are very vital, especially when you're doing your fundamental analysis. When you're doing a technical analysis, that's one thing, but then again, technical analysis needs the fundamentals. So understanding fundamental analysis requires you to understand the economic indicators so that you're able to catch that change, that impending change, that anomaly, because that's where you make the most money in the market, when you catch an anomaly, a trend that even many people may have not anticipated because everybody is maybe doing the same thing. So if you want to stand out as a trader, as an investor, or someone who is trying to multiply their money in the market, you need this video today. We're going to cover the 8 most important economic indicators that you need to look out for, especially if you're trading in the US market. That means if you're trading currency, that includes the US market as an influence, or trading things like Bitcoin, gold. If you trade such kind of things or you buy that kind of thing and you want to make some profit, this is a good video for you. So stick around. You're going to learn the eight most essential economic indicators to enable you to stay ahead of the game or ahead of your game. So without further ado, let's get to it. The first economic indicator is the GDP. The GDP stands for Gross Domestic Product. Gross Domestic Product is like a report card of a country, of how the country is performing economically from the quarter to the biannual to the annual GDP rates. So once we understand how much we consume as a country, how much we're exporting, how much we're investing, how much we bought, all that is tabulated to give us the gross domestic product. How much are we growing? That's where we measure our economic activity to know if a country is moving forward or a country is moving backward. So let's say, for example, the growth GDP of a country will indicate if the consumers are spending money, or what is the amount of money a government is spending, so that we're able to tabulate the level of currency, transfer and flow, and you're able to know where we're going as a country. Is this country growing or not? And also, it's a very great measure when we are determining the value of a currency through exchange, which leads to inflation and interest rates. Policies. So the GDP is very important. So to measure the GDP quarterly or biannually or yearly, the formula is to take the investments the countries have done, let's say the business investments, total business investments, total exports, total consumerism that's happening, and also total government expenditure. So once we add that, we're able to know where we are going as a country. So the GDP is very important when you're looking at, let's say you're trading something that includes USD. You're going to look at how the country is going to determine the future, let's say when it comes to interest rates and inflation, which tells you if this country is worth investing in, whether you're investing in the currency, the housing. This is something that will really allow you, whether you're in the USA or whatever country, the GDP of a country allows you to know how your country is growing from quarter to quarter basis to annual basis. So that's how you're able to know, So the GDP allows you to know the rate at which your country is growing economically. The second economic indicator that you must know about is the Consumer Price Index. Consumer Price Index allows you to know the rate at which consumerism is happening on a retail level. This measures the cost of the basket of goods compared to the base price. How much are people spending on basket of goods compared to the base price that they should be spending on. So this is usually one of the greatest indicators of inflation. If there is so much spending, that means the inflation will be high. Because at the end of the day, when there's too much spending, eventually there'll be more demand than supply. So when the monetary policy makers are making policies, they gotta look at that and measure that quarterly, or even, I think it's measured weekly, every month, or as a duration, at least quarterly, weekly. I'm not so sure over there, but I'm gonna give information on where to get this kind of news. When you follow the news in the economic calendar, you can see it's often measured at least monthly to know where we are as consumers. So a lot of inflation in the market leads to a lot of demand, less supply, and that equals inflation. And low demand or low consumerism, when the CPI is low, which is an indication of deflation, which can also lead to recession, because when also people are not buying in the market, that means that the prices are too high and there's no money supply to go by, and that can lead to a lot of supply and no demand. So it's always about a matter of balance, and many countries aim to put inflation at 2% at least, of which right now it's very high. It's at around 5%. That's why we have all these interest rates coming in, and the economy is a bit high right now. It's because of such kind of stuff. So looking out at the CPI allows you to understand the level of interest rates that are coming up, so that you'll know where to put your money, so that you'll know where to exit the market, so that you don't end up losing because the interest rates are higher than when you bought or when you sold. So that's one of the most important indicators that you must look at. The next indicator is consumer confidence. The Consumer Confidence Index, it measures the sentiments of consumers, thousands of consumers from household to household. So that shows where people are in their mindset when it comes to spending money, especially when a country is in crisis. For example, the one I know where it was a bit peculiar, it was when there were things like terrorist attacks like the 9/11. Of course, during such times, sentiments went lower. People didn't want to spend because there were a lot of terrorist attacks and civil unrest and panic. Another time when people were a bit uneasy to be able to spend was maybe during the fall of the real estate market, maybe when there's geopolitical unrest. People will be a bit withdrawn from spending. They want to save their money, or they'll be afraid to spend, or they won't even have the money to spend. The little they have, they want to retain and spend it on the necessities only. So consumer confidence shows you the confidence somebody has in that country to spend their money, whether it's with dollar or your local home currency. Consumer confidence is a good measure to understand the consumer sentiments when it comes to spending money. So that's something you have to look out for. And especially if you trade, or if you're keeping in touch with the market, if you look at the economic calendar, consumer confidence always comes up, and you're able to know how to know the confidence of people in that particular economy and their spending power in that particular time. The next economic indicator to look out for is job growth, like employment rates in that particular month. The employment report or the employment index is very important. It's actually as important as the GDP, because when people are employed, there's labor supply, the economy is moving, and people have money in their pockets. And people have money in their pockets, they're likely to spend. But when the job growth is low, it means spending will go lower and the economy is likely to go down in places where we wouldn't want to get to. So the level of job growth, where it's measured by the amount of hours people are working weekly, that level of job growth is important to understand the level of currency and economy that is expected to circulate, so that you'll know whether the economy you're investing in is growing or it's not. The sister to the employment report is the unemployment report. The unemployment data or indicator shows how many people have been out of work in a particular time. Although the unemployment data can be a bit lagging because it changes from time to time, and it depends on other factors to be able to be measured or to be determined, it's still an important indicator, especially over time. If a country is experiencing consistent unemployment rates, that means that economy is heading downward and it may not be the greatest economy to invest in at the time. So keeping in touch with the employment rates and the unemployment rates is important to understand the strength of the economy or the currency that you're investing in. Another important leading economic indicator is the housing stats. Housing stats is very important because the level of which people are buying houses and the level of which houses are being constructed, it often indicates the health of the economy, economic growth. It also indicates consumer spending and also indicates the rate of employment in the country. This is because when houses are being constructed, that means there's employment, and that means that when people are buying, the consumer rates goes up, because when you're buying housing, you also have to buy appliances, housing service, and that it's an economy that it's a symbiotic system. You build houses, you create jobs, people buy houses, that's consumerism going up. Consumerism going up means people are going to need appliances, furniture, home service, which creates more jobs and increases consumerism. And this is very important because now it means that when the housing stats go up, it means the economy is good. When the construction of housing is up, purchases are up, the housing statistics in general, that means that the economy is going up. And when the house statistics are down, it means the economy is going down. So these housing statistics are measured, in single family, multi-families, how many condos have been built, purchased, all that kind of stuff. So this is important to understand how the dollar is moving if you're investing in a US-based instrument or market. And it's also really good to understand if you're into real estate. You get to understand the cycle that's going on and where to take advantage if you're going to short the market or you're going to long the market. That's where you're going to decide based on the housing statistics that you have gathered or your research. Now let's look at this another economic indicator called business inventories. Business inventories includes the products that manufacturers may have, merchants and retailers. This is the amount of products they are moving or they are selling. So following up on the indicators or the fluctuations may help you understand where the economy is at. It's also a way to follow up on consumerism, because when business inventories are on high demand, it leads to expansion. That means people are buying stuff, there's a lot of supply, but when the inventories are full, no one is moving merchandise or product, that means that an economy may begin to fall. So understanding the trajectory of the economy, you need to understand also business inventories, the way manufacturers are moving, wholesalers or merchants and retailers. The level at which they're moving product and merchandise will let you know the health of the economy, depending on how people are buying, supply and demand. So understanding this helps you understand the country, the GDP and the level of currency movement in where you want to invest your money. The next in line is retail inventories. Retail inventories allows you to know also again supply and demand in the wholeness of things. Although retail inventories can be a bit more volatile than business inventories, because retail inventories now, that's when the merchandise is broken down into components that can fit everybody, and that's where most people are. The class of where most people are, it's retailers. So retail may show where the economy is headed, because a major swing downwards shows that the economy is ready for a downturn or the economy is falling. But also a major supply, or when people are buying a lot, it shows expansion. So retail inventories is important to keep up with, to understand the level of supply in the market when it comes to the retail world. The eighth indicator and the final indicator I wanted us to look at is the producer price index. The producer price index measures the raw materials prices that are in the manufacturing and the production stage. So this producer price index will track the raw materials that are still in commodity level. They will track the intermediate ones, the ones that are in production, and they're also going to track the price of the finished products that are in the shelves. What economists usually do is that they will go to tens of thousands of manufacturing companies and they measure the products of tens of thousands of products to be able to determine the price of the products when they hit the market. And this determines the consumer price index, which in turn will determine or predict how the consumer is going to spend. Because if the producer experienced higher cost in production, that means the consumer is going to experience higher cost in purchasing. And that is also an indicator of inflation, which also leads to interest rates in the monetary policy. It's influential with the monetary policy. So that is one of, and the final indicator that I wanted us to look into. If you want to be a successful investor, you've got to keep up with that. So to recap, these are the 8 economic indicators if you want to change your game when it comes to your investing and in your fundamental analysis. That includes the GDP, Consumer Price Index, which is the CPI. You're going to have to look at the unemployment rates, the employment rates, the housing stats. You're going to have to look at the Producer Price Index. You're going to look at retail inventories and business inventories. Once you get equipped with these economic indicators from time to time, that includes monthly, quarterly, biannually, and annually, you're able to determine the value of the economy and where the economy is flowing, and it's going to really influence you depending on the currency which you're going to invest. So if you like this video, you're going to have to share it and you're going to subscribe. And until next time, I'll see you later.